Most technical traders operate on a single flawed assumption that institutional market intent requires obvious price displacement. They intensely track the loud breaks in balance, scanning for an explosive vertical expansion slicing through the screen. Standard candlestick charts are incomplete diagnostic tools. They record where price has physically traveled, but they obscure the underlying inventory accumulation occurring at specific coordinates. Relying exclusively on high-velocity trend bars creates a severe operational blind spot. By the time a move becomes visually obvious to the retail crowd, the actual accumulation phase is completely over. The most aggressive institutional trends are engineered through a hidden algorithmic signature we call the Ghost A anomaly. This specific anomaly occurs when institutional execution algorithms achieve massive inventory displacement without moving the market price a single tick. We will deconstruct the precise order book mechanics engineering this state, moving past the raw price action to measure the mathematical tension underneath. True institutional intent is inversely correlated to the most obvious visuals on a standard chart. A market environment can appear completely stagnant on the visual surface, while simultaneously absorbing severe structural pressure just below. In a standard visible trend, price velocity and volume metrics synchronize. As price accelerates, the momentum metrics push outward in tandem. This diagram shows the footprint of a ghost anomaly. The price action forms a stagnant horizontal consolidation resembling low-volume chop. To see the true state, we decouple price from momentum by overlaying a subchart filter measuring internal volume deltas. Notice the mathematical divergence. The price line remains completely flat, but internal volume metrics explode into a towering momentum histogram. Algorithms actively load massive inventory at this coordinate, catching incoming orders without allowing the asset to drop. Extreme divergence between stagnant price and vertical momentum is the definitive mathematical fingerprint of cloaked institutional accumulation. We can map this market behavior using a mechanical physics model, where energy is generated and trapped without any forward movement. This schematic represents an engine dynamometer. Notice the two opposing metrics, RPM and torque on one side, and physical speed on the other. When the engine runs at maximum load, the RPM and torque skyrocket, generating an extreme spike of raw kinetic energy. Look at the physical speed metric. Because the vehicle is strapped tightly to the machine, the speed is pegged strictly at absolute zero. The energy is entirely contained within the rigid system. A standard visible trend operates like a car on an open street, where torque translates immediately to forward displacement. The ghost anomaly operates like the dyno model. Massive market energy is generated locally, but is completely absorbed and contained within a rigid zone. Flat horizontal chart structures under these conditions represent a state of severe kinetic compression. We can translate this kinetic compression into the actual market microstructure. This visualization tracks a level 2 order book during liquidation. Retail participants flood the market with aggressive sell orders. Suddenly, an institutional algorithm deploys a cloaked iceberg order, forming an immovable limit buy wall on the bid side. Watch the physical absorption. The retail sell orders collide with the limit bid and are instantly absorbed. The institutional machine catches every contract, creating absolute market gridlock. The price physically cannot drop because the resting bid is too thick. At the same time, the algorithm strictly suppresses upward movement. It holds the action perfectly sideways until its entire inventory quota is filled. These flat consolidations serve as predatory execution environments, built to harvest retail supply at wholesale prices. The operational challenge is differentiating this genuine institutional accumulation from random retail churn. This mechanical diagnostic index maps the precise physical signatures of 3 distinct market states. Focus on the ghost anomaly parameters. It is defined by dead sideways price action and a highly compressed fused structural ribbon state. Contrast this with the retail mirage. The mirage prints wide, overlapping bars and erratic ribbon loops, lacking true compression. The critical differentiator is internal momentum. The ghost triggers explosive volume divergence, while the mirage simply decays into a flat baseline. To the untrained retail operator, both environments look identically boring. They dismiss the flat chart and look away. Survival in the order book requires the mathematical precision to distinguish severe algorithmic tension from random retail noise. The anomaly reaches its structural breaking point the second the institutional accumulation protocol completes its inventory quota. Look at the Level 2 order book just prior to ignition. The limit buy wall is fully saturated with acquired inventory, and market tension is at its peak. The mechanical trigger is sudden. The institutional iceberg order is instantly pulled from the order book. With the artificial resistance gone, the previously stagnant price snaps upward in a sheer vertical vector through the ceiling of the consolidation box. This creates a liquidity vacuum. The trapped kinetic energy measured on the dyno instantly equalizes upward. This vertical expansion systematically traps the retail crowd. They ignored the slap price action and are forced to chase the top of an exhausted move. Operating within this vacuum requires a strict, risk-defined tactical execution strategy. Never execute a position inside the flat consolidation box. Entering inside the dyno room before the strap snap is flawed anticipation. This chart details the precise entry vector. Your execution trigger is placed exactly one tick above the structural high of that tight consolidation shelf. You enter the moment the box breaks. Your stop-loss invalidation line is drawn directly below the structural low of the narrow accumulation block. Notice the distance between the entry trigger and the invalidation line. Because the absorption zone was compressed, your structural risk unit is tight. These tight boundaries allow for larger position sizing because the exit point is clearly delineated by the institutional iceberg itself. Reliable mathematical edge in market microstructure originates from decoding the silent tension of the order book before price history reflects the move.